welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, we'll focus on our key market indicators as well as continue our discussion by reviewing the contributors and detractors of the market. And starting this week, we'll look at both the equity and bond markets to provide a more comprehensive view of the market movement and the impact to your portfolios. This week, I also want to highlight a webinar that John Mark and I will be hosting at the end of the month. If you enjoy these videos and are looking forward to doing a further deep dive into macroeconomic indicators for this year, we'll do a full year-to-date review. Please make sure to join our webinar by clicking on the webinar's link on our website. So with that, let's hop right in.
And now, on to the market recap with our key market indicators.
First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.8% growth. Woo, that's a big one. As of May 30th, which is significantly higher than last week's 2.4% growth. I truly believe that these are slightly inflated, and part of that is because of the amount of purchases that happened before the tariffs kicked in. And so I'm kind of curious to see what this actually ends up being in as we see the overall Q2 report come together in towards Q3. But I think it's important to highlight that this projection includes data from the U.S. Bureau of Economic Analysis and the personal consumption expenditures data that we discussed last week. Next, each week we look at initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims rose by 13,000 claims, ending at 240,000, while continuing claims also rose to 1.919 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement in both the 30-year and 15-year mortgage rates, ending at 6.89% and 6.03% respectively. Next, we'll look at investor sentiment. The latest update shows the bull-to-bear spread remained unchanged this week at 1%. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price-to-action relationship to the S&P 500. Remember, the VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 18.57. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 5.4% probability of a 0.25% decrease and a 94.6% probability of no decrease in June. The probabilities of a decrease in June continue to come down based on this data, and as we'll talk about it later, I expect this to continue to come down even further in the next few weeks. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.9%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 1.32%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.91%. Another volatile week this week, but we ended positive. And the winner for the biggest winner this week goes to growth and growth in income stocks. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around contributors and detractors of the market. All three major stock indices posted gains during the holiday shortened week. The S&P 500 returned 1.9%, which we just talked about. The Nasdaq Composite also was positive 2.01%, and the Dow Jones Industrial Average was positive 1.6%. Now these advances contributed to a robust May, with the S&P 500 up 6.2% for the month, the Nasdaq surging to 9.6% in the month, and the Dow rising to 3.9% for the month, which is marking the best monthly performance since November of 2023. Technology stocks led the gains, with the S&P 500 tech sector up more than 10% for the month. Now, on the other hand, Treasury yields experienced upward pressures across the curve. The 2-year note closed at 3.9%, which is down 33 basis points year to date. The 10-year note ended at 4.39%, which is a decrease of 18 basis points year to date. And the 30-year bond finished at 4.91%, which is up 12 basis points year to date. The yield curve steepened, and that's what we're looking at here, with the 2 to 10 spread widening by 16 basis points and the 10 to 30 spread by 30 basis points, indicating increased term premiums due to fiscal concerns. Now we'll talk in more detail about the contributors and detractors that drove major market indices and the movements last week. Let's take a look at contributors to the market performance last week. Starting with equities. Corporate earnings came in strong, with all eyes on NVIDIA. We saw market movement reflect the earnings beats. NVIDIA reported a 66% revenue increase to $44.06 billion, driven by strong AI demand. Tesla briefly exceeded an early entry threshold but fell back by week's end, despite upcoming robotaxi plans and public support from Donald Trump. Costco regained a buy point after solid earnings as well. We also saw strong macroeconomic indicators drive part of the market as well. Core PCE, or personal consumption expenditure inflation data, rose by just 0.1%, indicating subdued inflationary pressures. Consumer confidence also rebounded, supporting market sentiment. So inflation's going down, sentiment's coming up, earnings are looking good, all looking very strong for the market. Now, on the other hand, talking about bonds and fixed income, we saw a different picture, with most bond indices ending in the red for the month, with U.S. Treasuries facing their first monthly loss of 2025, reflecting investor caution amid fiscal uncertainties. Now, despite these challenges, certain bond sectors showed resilience. Investment grade and high yield corporates posted positive returns, outperforming overall treasuries. Municipal bond yields ended the week mixed, with new issuances of $13.8 billion and fund inflows of $767 million. Now, talking about detractors that moved the market this week, as we've seen much throughout the year, they've been highly focused on the tariff impact and sentiment. So this week, unfortunately, is no different. Trade policy remained a focal point for the market and investors. President Trump announced plans to double tariffs on imported steel and aluminum, raising concerns over trade tensions, especially with China. However, the U.S. Court of International Trade struck down most of these tariffs, providing a temporary relief to markets. The true impact of these tariffs in the market may not be seen till later this week, so we'll be watching it very, very closely. As mentioned previously, the Treasuries market was most impacted last week, with key detractor drivers. The bond market faced its first monthly loss of 2025, and there is continued concern around increasing debt levels. JP Morgan's CEO Jamie Dimon warned of a potential bond market instability due to escalating U.S. debt levels. The resurgence of quote-unquote bond vigilantes reflected investor concerns over inflation and fiscal instability, leading to higher long-term yields. As mentioned earlier, the yield curve has steepened, with the 2 to 10 spread, 2-year and 10-year spread widening by 16 basis points, and the 10-year and 30-year spread by 30 basis points, indicating increased term premiums due to fiscal concerns. So let's discuss what all of this means and what we believe the market outlook looks like. Now, within the equity market, let's focus on how this month went and certainly the factors that we're tracking moving forward. I think it's important to highlight that while May concluded on a high note, uncertainties still remain. The potential for increased market volatility if job growth surprises to the upside is something we're watching closely, and all of this could potentially delay federal rate cuts. This week, Tuesday, is a big day for the JOLTS job data being released. Weekly, we discuss the unemployment rate. Weekly, we discuss unemployment from the lens of the unemployment claims and continuing claims data. Now, I'm going to incorporate new data points into that part of the discussion in the upcoming weeks, but keep in mind, we also need to track the number of hires and the number of employees that left their job, willingly or not. Along with the jobs data, ongoing trade tensions and tariff policies could impact corporate earnings and economic growth. We recommend that all investors should consult your advisor, stay informed, and consider a cautious approach amid these uncertainties. Now, on the bond and fixed income side, the Federal Reserve maintained the federal funds rate at 4.25% to 4.5%, adopting a wait-and-see approach amid economic uncertainties. Market expectations for rate cuts have been postponed, with futures pricing two quarter point cuts in the later half of this year, but I believe it's likely going to be closer to one. Looking ahead, the bond market remains sensitive to fiscal policy developments, inflation trends, and the Federal Reserve actions. We recommend that investors should monitor these factors closely, as they will influence yield movements and bond valuations in the upcoming months. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our if you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.